if you go back, what was it, 3 years ago, when the Russian treasuries, the 300 billion, were basically sequestered, that's what kicked off the move away from dollars and central banks wanting to buy gold to basically hedge. They're thinking if Russia can have their reserves stolen, so can we. So if you look at a chart, the following day, gold started to look like a tractor in first gear. Now, silver is not just a monetary metal. I mean, there's industrial uses, medicinal uses, technological uses. Uh, all that demand overwhelmed the above ground supply. And as you mentioned, what the mines are producing is roughly, call it 850, 900 million ounces. And it looks like this year, we're probably going to end up with a demand of 1.3 billion ounces. So there's your shortage. And when you tell a human being that they can't have something, they want it even more. And what you're looking at now is the paper markets are beginning to break. And we're moving toward more of a, like you said with that commercial, I want my money and I want it now. We're moving toward a cash and carry market. The Asians do not trust contracts. The Asians want to buy something and have it delivered. And there's your problem. That's the only way to adjust the supply and demand, the only way to ration demand and increase supply, but slowly, because mines can't increase supply quickly. The only way to do that is to increase the price. And that's what you're watching.
Yeah, could you walk me through the shorts? So obviously you have these banks that have been engaging in this markets to make a profit or whatnot. And so, to my understanding, they sell these silver contracts they do not currently own, and they promise to deliver silver at a fixed price, a later price. And so they're betting on the price to go down. Like, okay, if we sell it to you at 60 today, we believe that silver is going to go down to 40 or whatnot. And so that's their margin or their profit. But the price of silver just keeps going up. And so what's happening with these shorts that are institutions and banks that are trying to short the market?
Yeah, it's not that simple. The shorts, I do not believe, understand that this has been going on for 50 years, or at least since 1986. I'm sorry, 1976, when the COMEX started and they had the paper contracts. Understand that silver is an extremely small market. Even at today's prices, I think the total global production is only 40 or $50 billion a year, which is nothing in today's world. I don't believe that it was profit oriented to begin with.
Mm-hmm.
The central banks colluded around the world to lease gold and have that gold sold into the market to suppress the price. The reason that was done is because gold is the anti-dollar, if you will. It's the anti-fiat. It's direct competition for fiat currencies. Now, if you suppress gold, you can't let silver skyrocket. So they suppress silver, but silver is easier to suppress because it's such a small market. And they got used to being able to smash the price, scare the speculators out, and then they made a profit. But overall, it was not profit motivated. It was simply suppression motivated so that these governments, particularly the US government, could borrow in unlimited quantities. If gold and silver are not going higher, that means the thermometer is not showing a fever. So if you break the thermometer, you can say there's no fever, gold bad, dollar good. Now the thermometer is breaking. The paper contracts, they sold way, way, way too many. And we're at the point now where people are standing for delivery. And guess what? The metal doesn't exist to supply all these contracts that have been sold short. And now you're seeing price go higher and these banks are losing billions of dollars.
Yeah. Wow. Okay, that's very enlightening. So obviously they profited along the way, but that wasn't the motive. And so
Right.
and you said that this happened back in the 70s. So this like post
Yeah.
Nixon. Um,
Yeah. 1976 is when the Comex started trading contracts. And then, of course, you had the Hunt brothers in the late, 1978, 79, 1980. Um, they tried to corner the market. They got greedy. Had they done it more on a cash basis, they couldn't have been pushed out. But what happened is they got leveraged on Comex, and Comex changed the rules and said we will not accept any buy orders. You can only sell. And silver went from $50 to $10 in what 6 or 8 months time. So they crashed silver, bankrupted the Hunt brothers, and that was done because the Hunt brothers used too much paper.
mm.
In a cash and carry world, that could not have happened. It would have taken longer and more money for the Hunts to corner the market, but I believe they could have.
Okay. Okay. And you mentioned paper, so there's some different ideas of, or I guess speculation on how many paper contracts there is for like 1 ounce per silver. Is that number like over 100 or something like that?
I've heard numbers as high as 300 to 1. Also understand that ETFs were created, and as soon as they came out, I said this is going to act as a siphon for capital that was going to go into real metal, but now it's going into the ETFs. And if you look at their prospectuses, they don't have to own real metal. They can have contracts. So it was a way to dilute the buying power versus the existing supply. So you have ETFs on one hand, you also have the LBMA and CME on the other hand with uh, with futures contracts as opposed to strictly cash and carry, cash delivery.
Okay. Okay, got it. Yeah, that's a lot of paper for per ounce. That's a lot of paper. Do you have an idea of like what that looks like for gold? I mean, obviously they're engaging in these same types
Less.
of. It's less.
Yeah, it's much less. Yeah.
Okay. Okay, got it. So thinking about the where silver is at, folks are coming and demanding their metal. So you have the industrial use and such. What's kind of your outlook kind of moving forward? Like what happens from here? So obviously some of these shorts they're running for cover, whatnot, and I mean the price of silver just continues to grind higher. What happens from here?
It ends up in a failure to deliver. It ends up with too many people saying, I want my silver, and that silver not being available. The problem with that is, as soon as that happens, that day or the next day, you'll see the same thing in gold. Then you'll see it in palladium. Then you'll see it in platinum. Then you'll see it in other futures contracts. People will think, well, wait a minute. Have they oversold pork bellies? Have they oversold wheat? Have they oversold, whatever? It will lead to a break in confidence. And once confidence breaks, then you've got a problem in the credit markets because credit runs on trust, runs on confidence. Nobody's going to lend. I mean, talk about uh, an old story. Think about Wimpy on Popeye. I'll gladly pay you Tuesday for a hamburger today. If credit hiccups or if credit ceases, the entire world, everything you do, everything you touch, runs on credit. The real economy runs on credit, and so does the financial world, the financial economy. So once this affects credit, then it's game over. You'll see markets close, and that's where the great taking will take over. They put these laws into effect. The ink is dry. They didn't do that just in case. They did it to use it.
Got it. And so you're saying something very important, and I think that the audience should know because some people are getting into the metals because they see it as like, oh, this is a way to make money or to make more dollars, right?
But
And such. And but you're saying like this is something way more structural, a lot more
it's
structural risk and
systemic.
such, right?
Yes, it's systemic. Um, the bottom line is gold nor silver can bankrupt. They cannot default in a world that is entering a default phase because we put too much debt on the books globally. The money does not exist to pay both the principal and the interest. So what have they done? What do they have? What are they doing? They're printing, money supplies over time have exploded, and the explosion of the money supplies dilutes the value. So now you've got like you have a circular, going down the drain. The more they print, the lower the value of the currencies, and thus the higher price, if you will. Gold and silver do nothing. It's the currencies that go up and down. And the currencies are devaluing greatly, and there's your price explosion.
Okay, got it. So there's I'm imagining that you study cycles as well, in terms of
Somewhat,
to some degree. So there's been talk about the 80-year debt cycle, fourth turning.
right.
The great taking and such, and you think about that type of world, right? And it's like, okay, well, this is unimaginable for many Americans, or just many, of the average folks. And so, could you walk us through what does that world look like? I mean, when the dollar, um, just crashes, or just loses a significant amount of value.
Yeah, we've been trained, if you will, from 1971 to believe that that the dollar is still. Uh, You'd be amazed at how many people still believe that the dollar is backed by gold. It is backed by nothing. It's backed by the full faith and credit of an insolvent institution. This is the end of, if you want to call it the fiat cycle, whatever you want to call it. This is the end of fiat. This is the flame out on fiat versus gold and silver, which are real money and cannot default.
Got it. What's your view on the equities related to gold and silver? Obviously, you got these miners that are getting the metal out of the ground. Do they become like nationalized, or like what's kind of your view there on, is that an
Yeah,
opportunity, or do you see that as more risk?
yeah, no, that's a very real possibility that you see some nationalizations. Uh, I believe that equities in North America are probably most at risk because, I mean, look at the finances of the US, look at the finances of Canada. It would just make sense that they try to, uh, they try to confiscate gold in the ground. If you go back to the year 1900, mining companies resembled what utility companies are today because they were mining money, and they would they would pay out a good dividend. They were very stable, solid. They were widow and orphan type stocks. As far as going forward, that it's going to be much different because we're not going to be in the world of 1900 going forward because as far as mining concerns are concerned, um, miners are going to be they dig money out of the ground, and if that's happening in a backdrop where fiat currencies are failing, and we get to the point where gold and silver become very scarce for investors to purchase, what's your alternative? You're going to have to purchase mining companies if you want exposure to metal that you can't buy. And that's assuming that markets stay open. And I don't assume that, but it's assuming markets stay open. Just understand that if you're buying a miner, and there's all types of miners. I mean, there's explorers, there's juniors, there's majors, from the bottom of the chain all the way up. Um, the more senior you get, the less risk there is, but you also have to look at the geographical area that your mine is at. I mean, is it at risk of confiscation? What I'm trying to say is there's much more risk in miners than there is in the metal itself, but it may become the only choice if you can't buy gold or silver, if it doesn't exist to buy.
Our project is right in the
Hmm. Okay, so yeah, if it doesn't exist to buy, and then also we know that we've had confiscation in America's history and such, and so do you still see, or do you see confiscation as a current risk as far as like, especially if everything goes to bad, like if we go have a significant crisis, to I mean like the Great Depression, right? Do you see confiscation as probable, possible? Where are you kind of at on that?
I don't think there'll be a confiscation because well, first off, people are worried about the government going door to door.